Yo, what is going on, everybody? Welcome to the channel. Today, I got something completely different for you all. I'm going to be talking about some financial literacy. There's been a lot of recent bank collapses, which is crazy because it hasn't happened since the 2008 recession. And not that they've flown under the radar, but I don't think a lot of people really understand all that went into it. So today, I kind of made a PowerPoint of a quick and comprehensive way to kind of explain how Silicon Valley failed. And I'm been really, I know it's random, but I've been really interested in this topic recently, and just the whole economy as a whole, and kind of understanding how money works and all that kind of stuff. So hopefully I'll teach you something today, and yeah, hopefully I'll make videos in the future. So this will be number one. What is Silicon Valley Bank? So Silicon Valley Bank was the 16th largest in the United States. They were no small player. They were a huge company that was founded in 1983, and they prided themselves on banking for nearly half of all U.S. venture-backed startups. So what is a US or what is a venture-backed startup? Basically, it's a startup company that says, "Hey, we have a really good idea, but we don't have the money. We don't have the monetary funds to back up what we have doing." So they'll go ahead and pitch this idea to Silicon Valley, and they'll say, "Hey, we like what you're doing. We're interested in giving you some money, and you'll probably pay it back with some interest later." But that's beside the topic. So they were really this was their niche is they would help these venture-backed startups. So they played a huge role in supporting the tech sector. They're like the premier company as far as technology came, and they were responsible for starting companies like Roku and Vox. Um, they really boomed in 2020, and they actually increased bank deposits by over 100 billion this year, which is a lot of money that they have to play with. So yeah, this is like I said, this is no small player in the industry. So, as all of us should know, they failed recently. They are no longer. So, what causes downfall? In simple terms, it was an old-fashioned bank run. So what that is everybody, there's a contagion of fear where people don't think that they'll get their money again. So everybody runs to the bank to withdraw their money. So what banks do, if you don't know, banks don't really hold on to your money. They don't put it in a safe. What they do is they take your deposits and invest them in safe securities. And many of these are called treasury bonds, which is something that the government offers, where it's you give them a lump sum of money now, and you get a 5% rate. That's just a random number I came up with. And then in, let's say, 10 years, you get all your money back plus that 5%. So this is the most secure investment because the government, they will always return your money. So banks are limited by this thing called fractional reserve banking, which says that if you get if usually it's 10%. So if you put $1,000 in, they have to keep $100 on hand. So if you wanted to, or if you want to withdraw your money again, they have some money on hand. So what happened during 2020 is they actually decreased this fractional reserve from usually it sits around 10%. They decreased it to zero. So banks didn't have to have anything on hand, which is extremely important in their failure and what happens later. So as the Federal Reserve would increase these interest rates, the bonds would become worthless. They become underwater assets, which I'll explain underwater assets in two ways. One is super easy. Let's say I buy a house for $1 million and it's only worth $500,000 on the market. That's an underwater asset because I took an unrealized loss on that, right? So yeah, what they did is they bought bonds. What Silicon Valley did is they bought a lot of bonds for 1.5% interest, and now that the inflation is crazy, the Federal Reserve bumped interest rates up. So now you can get a bond for 7%. So that 1.5% bond is worth a lot less than it would that 7% bond, especially on the bond market, because nobody wants to buy that. They could get a new one for 7%, right? So typically they would just wait for these bonds to mature, and they wouldn't really take a loss. They would just have that minimal gain of 1.5%. But they needed, with all these people withdrawing money, they needed some cash on hand. So they ended up taking that. They ended up cashing them out and taking a net loss, which I'll talk about in a bit. And yeah, there was a slowdown in venture capital investments. So deposits, money that they were getting slowed down a lot. So that's why they kind of had to cash out these bonds. So what started the bank run? I won't read this word for word, but I will kind of highlight the key points. So it spooked a lot of markets and clients when they sold all this. They took almost a $2 billion loss on $21 billion of securities, so almost 10%. And so yeah, the stock price plunged, and they actually took it off the market. So this is like a huge red flag. And big name VCs such as Peter Thiel and the Union Square Ventures reportedly started to tell their companies to pull their money out of the bank while they could. And that's a scary statement. While they could is that causes fear. People want to get their money now because will I ever see it again? It's a scary thing. So another tweet that I found was from a tech investor. He wrote, "You should be absolutely terrified right now. That is the proper reaction." So as you can see, it causes contagion of fear where everybody wants to get their money out while they can. So what did this result in? So like I said, they sold all the bonds that they had bought in 2020 or a few years back, and sitting on an unrealized loss, they decided to sell everything for nearly a $2 billion loss. So people saw this and they're like, "Hey, what's happening? This is weird," you know. So um, it's important to note that the FDIC will cover $250,000. Anybody that banks anywhere, you are guaranteed to see $250,000 again. It doesn't matter who you are, what bank you do, the FDIC will cover that sum of money. But a lot of people had a lot more than that. They had millions of dollars banked, and they were wondering, "Hey, am I going to see this again? You know, I know I'll see 250,000, but am I going to see my full $10 million?" So on Sunday evening, the secretary of the Treasury, her name is Janet Yellen. She announced that the Fed was going to bail out all these depositors, so the depositors would actually get their money back. Now, the next question that arises is, well, where is this money coming from? You know, is this, is this something that the taxpayers are going to have to be responsible for? So they made it very clear that taxpayers would not be responsible for covering these losses, and instead, the Deposit Insurance Fund, the DIF, was going to bail out these depositors. So the DIF is the same sector that covers the $250,000. So they're just taking another step up and saying that we'll cover everything, and they actually have access to $100 billion. It's a confusing process of how they're able to regulate their money. You can look it up. I'm sure you can find some information about it. It's just confusing to explain. So they actually have access to $100 billion. So they're good for it, you know. So they're able to bail out these people. Um, and so, yeah, I guess what are the takeaways of this dilemma that SVB faced? So, Silicon Valley Bank's main problem was their lack of diversification. They had all their eggs in one basket, and when over 50% of your business in one industry, obviously when the industry is going crazy, you're good. You're making a lot of money, and this was the case in 2020, and all the way to 2022 ish. But then when stuff doesn't go your way, you're prone to drastic losses, and that's what we saw this year in these last couple of weeks. So I think it's just important to note that banks don't keep your money. The financial system isn't so stable. When you go put $1,000 into the bank, they're running off with $900 of that instantly and putting it somewhere. And usually this is fine. That's just how the system works. That's just how everything's run for a while. But you see that it gets exposed when the banks make these, I wouldn't say faulty investments, but I think they were incentivized to buy these bonds in 2020, and then you saw once inflation was crazy, the Fed had no choice but to raise interest rates. It sucks because everybody gets hurt by that, but you have to stop inflation because that kills the lower middle class. Inflation hits the lower middle class the hardest. So it's super important to kind of keep that under control. And when we saw 8%, 9%, that's a scary thing. Your money's decreasing a tenth every single year. That's crazy. So the Fed had to raise these rates, and it just hurt a lot of previous investors. Right now is a fair time because you can get these awesome interest rates, but for previous investors, it really hurt them. And Silicon Valley just happened to put a lot of their money into these treasury bonds. 1.5 is measly compared to the 7% that you can get today, right? So I guess another two things are we are a debt-based economy. Saving money is not incentivized. And I guess the last point that I'll make before I wrap this video up, companies invest about all the money they can because if they don't, they have to pay taxes on it, right? So if you have $100 million, you're gonna a lot of that money is going to go bye bye. You're gonna give that to the federal government. Uncle Sam's gonna take his piece, and you're not gonna ever see that money again. But if you choose to reinvest in your company, which you should have full faith into, right? You want your company to grow as large as it can, then you kind of you miss a lot of these tax. You have to pay a lot of taxes along the way. So instead of paying these taxes, many companies choose to reinvest their money, and this is how America works. It is not an economy that is incentivizing saving. As crappy as it is, and as much as we want to save money, it's a debt-based economy. There's a lot of debt that goes around, and that's how the world runs. And for Silicon Valley, the debt caught up with them. I think it's as simple as that. So hope you all enjoyed. I hope this kind of cleared things up a little bit. If you have any further questions, go ahead and leave them in the comments. I'll be responding to all of them. I want to run with this, and I know that this is kind of just a quick video, very very scattered. Not I didn't take a lot of time to make this or anything, and I want to set the production up in the future. But I just wanted to get some kind of media out there because this is what I want to do in the future, and it's going to mean a lot to me, and I just want to have some baseline out there. And I think that this is very relevant, and the whole Silicon Valley thing is crazy. And there's been, I think, 3 or 4 more banks that have crashed in the last couple weeks. which is wild because this hasn't happened since the 2008 recession, and that was a crisis. That was a housing crisis. That was a terrible thing. So I hope I taught you something. Like I said, leave a question if you have any further questions. And then yeah, in the future, let me know what video ideas you guys have. I'm really interested in stocks. You can see like on the left side, I have like a watch list of some sorts that I'd love to dive into each and every one of them and tell you why I have investments in them, and why I think they're a good idea and that other people should be investing. And any other questions about money that you have, because I think that I want to start doing weekly videos, but I need topic ideas, and I want to keep people intrigued. Not everybody has the same interests, and some people might be very bored out by the whole Silicon Valley thing, but they might want to know how to invest or what stocks to get into and stuff like that. So yeah, hopefully I taught you guys something. I really appreciate you sticking around this long. It means a lot to me, and go about your day. And please, if you have any questions, leave them down. Don't forget to leave a like, and hopefully I'll see you again in the future. Thank you.